Ladies and gentlemen, good day and welcome to the UTI Asset Management Company Limited Q2 and H1 FY26 earnings conference call. From the management, we have with us Mr. Imtiazur Rahman, Managing Director and CEO, Mr. Vetri Subramaniam, Managing Director and CEO Designate, Mr. Vinay Lakhotia, Chief Financial Officer and Head Corporate Strategy, Mr. Surojit Saha, Group Financial Advisor, and Mr. Sandeep Samsi, Head Investor Relations, Marketing and Corporate Communications. We also have with us the Investor Relations team from Adfactors PR. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star and then 0 on your touchtone phone. Please note that this conference is being recorded. Before we begin, I would like to mention that some of the statements made in today's presentation may be forward-looking in nature and may involve risks and uncertainties. Please note the disclaimer mentioning these risks and uncertainties are on the disclaimer slide of the Investor Relations presentation that has been shared earlier. I would now hand the conference over to Mr. Imtiazur Rahman for opening remarks.
Thank you. Good evening, everyone. We are delighted to have you with us for the review of our financial and operational performance for the second quarter and half year ended 30th September 2025. Our financial statements, press release and investor presentation have been uploaded on the website of stock exchanges, and we trust you have had the opportunity to review them. I have with me my distinguished colleagues, Mr. Vetri Subramaniam, MD and CEO Designate of UTI AMC, Mr. Vinay Lakhotia, CFO and Head of Strategy, Mr. Surojit Saha, Chief Financial Advisor of the company, and Mr. Sandeep Samsi, Head of Investor Relations, Marketing and Corporate Communications. Before I request Vetri to share with all of us about the macroeconomic view and industry update, I would like to share with you few important developments in UTI AMC. As many of you are aware, I have had the privilege of leading UTI AMC since 2018, guiding the company through its evolution into a listed entity and driving significant growth. Under our collective efforts, UTI AMC's market capitalization has grown threefold since our 2020 listing, surpassing rupees 18,000 crore, with asset under management soaring from rupees 3.99 lakh crore in 2019 to 22.42 lakh crore in September of 2022-25. As a continuation of our succession plan and with full confidence in our next generation of leadership, the board has unanimously decided to appoint Mr. Vetri Subramaniam as an incoming MD and CEO of UTI AMC with effect from 1st February 2026. 1st February marks UTI AMC's foundation day, and I believe it is a fitting moment for me to pass the baton to Vetri. As Vetri has been an integral part of our success story since he joined UTI AMC in 2017, and his leadership, vision, and deep industry expertise makes him the ideal choice to guide UTI in its next chapter. To ensure a seamless transition, I will serve as a strategic advisor to the MD CEO from 1st February 2026 to 12th June 2026, supporting Vetri and his team. I am confident that under Vetri's leadership, UTI AMC will continue to deliver exceptional value to our customers, shareholders, and stakeholders, while advancing our mission to help millions of Indians achieve their financial aspirations and also globally. Now I request Vetri to share with you the financial and other updates and the macroeconomic data of the industry as well as of UTI AMC. Vetri, over to you.
Thank you, Imtiaz, and I will now, as Imtiaz suggested, I'll go into the macroeconomic background of what has been happening. The last few months have brought volatility to the Indian markets amid rising geopolitical tension and also trade challenges. India's growth story remains resilient. This is underpinned by robust domestic demand, healthy private investment, and a vibrant services sector. Global conflicts and trade headwinds like the US tariffs may momentarily slow manufacturing and exports, but India's structural strength is well intact. With steady infrastructure spending and firm consumer momentum, including the benefit of the recent GST rationalization, the economy is poised to maintain its lead among emerging markets in terms of growth. Indian equities and mutual funds, I'll turn the spotlight to that. In H1 of FY26, we witnessed strong investor participation, particularly from retail investors. The industry folio count grew to 25.19 crore as of September 2025. The retail mutual fund folios stood at 19.77 crore for September 2025, with retail AUM at 44.61 lakh crore for these categories. This is equity, hybrid, and solution-oriented schemes. Total industry AUM grew to 75.61 lakh crore as of September 2025, up from 75.19 lakh crore, reflecting a 0.56% increase month on month. Q2 also reflected some degree of investor caution. Equity MF inflows fell 9% to rupees 30,422 crore in September from 33,430 crore in the previous month. In September, the SIP stoppage ratio rose to 76.27%, up from 74.51% in August. Overall sentiment of retail investors remains strong. SIPs have reached a new milestone with record monthly contribution of rupees 29,361 crore and 9.25 crore active accounts as against 8.98 crore posted in August. The SIP AUM is at rupees 15.52 lakh crore for September 2025. This amounts to 20.53% of total mutual fund industry assets. Moving on to the performance of UTI. In line with the industry, UTI Group's total AUM stood at 22.42 lakh crore as of 30th September. This is a growth of 11% from 20.16 lakh crore a year ago. Our mutual fund AUM reached 3.78 lakh crore compared to rupees 3.43 lakh crore last year. At the end of Q2, as of 30th September, our folios stand at 1.36 crore. Considering the market volatility, our go-to-market strategy remains focused on the hybrid category of funds. I'm happy to share with you some of UTI AMC's achievements for the first half of FY26. Our strategic vision continues to guide us as we expand across the vibrant B30 cities and the established top 30 markets. Beyond 30 cities remains a cornerstone of our success, contributing approximately 80% of our AUM, and these markets are growing strongly. Technology is central to this journey. Our investor and distributor-facing apps have seen strong adoption, providing convenience and enhanced functionality to investors and distributors. The association with Salesforce and ONDC in their respective capacities have enhanced our potential significantly, whether it is our ability to keep engaged with our investors or with our partners, and also to facilitate ease of transaction for all investors. Financial literacy remains a key priority, and through our initiatives such as UTI Swatantra and FLY, we continue to empower individuals with the knowledge to make informed investment decisions. As regards new fund launches, we launched the UTI Multi-Cap Fund in May. This has been designed as an all-round investment solution and showcases the depth of our research capability. It completes our product suite and is a distinctive proposition within our diversified equity offerings. As of 30th September, the fund had assets of 1,576 crore, around 67% more than what we collected during the NFO. Our distribution network continues to gain strength. Through targeted training and workshops, we've enhanced the collaboration between distributors, fund managers, and product teams. On the global front, the expansion of our New York office and progress on regulatory approvals in the DIFC have reinforced our cross-border advisory presence. Through these strategic endeavors, expanding reach, driving digital adoption, launching innovative products, empowering investors, and fortifying distribution, UTI Asset Management Company is firmly positioned to sustain growth and deliver long-term value to stakeholders in FY26 and the years beyond. Thank you for your continued trust and support. I will now hand over to our Head of Investor Relations, Marketing and Corporate Communication, Sandeep Samsi, who will brief you on more details regarding our performance. Over to you, Sandeep.
Thank you, sir. I will take you through UTI Mutual Fund's performance during the second quarter and half year ended 30th September 2025. Talking about UTI Mutual Fund's performance, UTI was able to capture a market share of 6.2% of the gross sales of the industry during this quarter and market share of 6.4% of the gross sales for the first half of the financial year 26. Our active equity plus hybrid quarterly average AUM for the quarter ended September 2025 stood at rupees 1,33,202 crores. Quarterly average AUM for index and ETF stood at rupees 1,62,443 crores, up by 4.75% in the second quarter, commensurate with growth in the overall passive investment. ETF and index fund net inflow stood at rupees 4,848 crores. UTI added 2.4 lakh folios, taking up the number of live folios to 1.36 crore as on 30th September 2025. Our SIP AUM witnessed a growth of 5.98% over the corresponding quarter of last year, reaching to rupees 42,267 crore as of September 2025. The SIP inflows for the second quarter stood at rupees 2,338 crore. The SIP gross inflows for UTI Mutual Fund witnessed a year-on-year growth of 12.04%, with the average SIP ticket size being rupees 3,273 for September 2025. For the first half of the year, FY26, SIP inflows were rupees 4,599 crores, higher by 17.70% as compared to rupees 3,907 crores in the first half of FY25. An important update, pursuant to the meeting held on 23rd September 2025, the Board of Directors of UTI AMC approved the implementation of the Voluntary Retirement Scheme VRS for select categories of employees, effective from 1st of October 2025. As per the scheme, eligible employees can submit their VRS applications till 31st October 2025. The financial impact of the scheme will be determined based on the actual number of applications received and will be communicated to the stock exchanges in due course in line with the regulatory requirement. As part of the VRS package, family pension benefits have also been revised. The one-time financial aspect of this revision, as per the actual valuation, is rupees 25 crores, which has been fully accounted for in the financial results for this quarter. This initiative is designed to offer a structured and dignified exit framework for eligible employees while strategically realigning the workforce to support the organization's future business priorities. Coming to UTI AMC financials on consolidated basis, during the second quarter, the core income of the company stood at rupees 390 crores, up by 5% year-on-year and 3% quarter-on-quarter. The consolidated core PAT for the second quarter is rupees 107 crores, which includes the impact of revision in the family pension. Adjusted for the same, the normalized consolidated core PAT for the quarter is rupees 127 crores, down by 5% year-on-year and up by 4% quarter-on-quarter. For the half year, the consolidated core PAT was rupees 228 crores, down by 8% YOY, and normalized consolidated core PAT, excluding the impact of family pension, is rupees 248 crores, up by 1% YOY. On standalone basis, during the second quarter, core income of the company on standalone basis stood at rupees 319 crores, up by 5% YOY and 3% quarter-on-quarter. Standalone core PAT for the second quarter is rupees 104 crores, which includes the impact of family pension revision. Adjusted for this, the normalized standalone core PAT for the quarter is rupees 124 crores, up by 7% YOY and 5% quarter-on-quarter. For the half year, the standalone core PAT was rupees 221 crores, up by 3% YOY, and normalized core PAT, excluding the impact of family pension for the half year, is rupees 241 crores, up by 13% YOY. On the investment highlights, in fixed income, we have witnessed consistent growth in liquid as well as non-liquid categories. On the equity side, our value-oriented scheme continued to do well over the 3-year and 5-year period, Some of our growth-oriented schemes have witnessed a pickup in performance over the last 1 year. By substantially increasing the fund managers' engagement with distributors in both the top 30 and beyond 30 cities, we have strengthened our partnerships and enhanced strategic clarity around our fund offerings. Investor education. Reinforcing our commitment to investor education, we conducted 700 plus programs, including 250 sessions, especially designed for the women investors. In the first half of the financial year 2026, more than 6,700 students participated in our Financial Literacy for Youth FLY program, under which we conducted financial awareness sessions in colleges. Close to 70% of these students registered for SEBI Investors certification course, and out of these, 81% have already cleared the exam. On our IT and digital assets, we continue to invest strategically in technology infrastructure and adopting artificial intelligence, machine learning, and generative AI. We have amplified our security operations with a focus on cyber security. Last year, we partnered with Salesforce for marketing automation tool to send customized communication to our investors. A case study on this has been published now by Salesforce. We have also associated with ONDC, that is the Open Network for Digital Commerce, and are available on the network for onboarding and financial transactions. 41% of our total gross sales for equity and hybrid funds are being mobilized through the digital platform in the Q2 of FY26. We have gone live with UTI autopay implementation for SIP via the UTI autopay and at valid UPI handles as per the mandate given by MP. On UTI Pension Fund Limited, our 100% owned subsidiary UTI Pension Fund Limited has recorded a growth of 15.82% year-on-year in its AUM, reaching rupees 3.89 lakh crore as on the Q2 of FY26, and currently it manages 24.62% of the NPS industry's AUM. The PAT for the half year is rupees 28 crores, a decline of 3.4% YOY. The point of presence business that commenced recently has been performing well. We currently operate through 31 branches across India and plan to take the total number of branches to 40 in FY26. In the first half of FY26, we added 119 clients. We are delighted to share that UTI PFL won the CNBC TV18 India Risk Management Awards for the year 24-25. We have filed 4 new schemes under the multi-scheme framework MSF based on the circular issued by PFRDA on 16 September 2025. On UTI International, UTI International has rebranded the logo as UTI Investments, reflecting a more contemporary identity to resonate strongly with international investors. The AUM at UTI International is $2.66 billion or rupees 23,647 crore as on 30th September 2025. One of our popular funds, UTI India Dynamic Equity Fund, domiciled in Ireland, has an AUM of $874 million. We successfully secured allocation into UTI IDEF from Europe despite a challenging market environment and have continued to sustain our assets. We have also strengthened coverage and business development through senior leadership hires across regions, bringing deep institutional expertise. On UTI Alternatives Private Limited, UTI Alternatives Private Limited has a total AUM of rupees 2,669 crore as on 30th September 2025. This excludes the co-investment portfolio management services of rupees 162 crores. We have now successfully exited HDOC 1 in FY25. HDOC 2 and HDOC 3 have active commitments of rupees 755 crores and the fund is currently in investing stage. We have launched the fourth fund of our HDOC series in Q2, and this fund has been planned as a 1,500 crore fund. UTI Multi-Opportunities Fund 1 has an AUM of 1,598 crores. Currently, the fund is in investing stage. UTI Real Estate Opportunities Fund 1 is currently in fundraising and is investing with commitments of rupees 164 crores. We have initiated the process for upgrading the GIFT City FME license from non-retail to retail to allow launch of mutual fund schemes. I would now request the Managing Director and CEO for his concluding remarks.
Thank you, Sandeep, for sharing operational and financial updates of the company. Before we begin the question and answer, on behalf of the entire UTI family, I would like to wish you and your family happy Dhanteras and prosperous Diwali. We may now open the forum for Q&A. Thank you.
Thank you very much. We will now begin with the question and answer session. Anyone who wishes to ask a question may press star and then 1 on their touchtone phone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Again, to register for a question, please press star and 1. Our first question comes from the line of Mohit Mangal from Centrum. Please go ahead.
Yeah, thanks for the opportunity. My first question is towards the flows. So if I look at, hybrid category, which is our main target category, last year we had around 19 billion of net inflows, and even H2 was better. But in H1, that actually kind of, declined to around 4 billion. So, how can we capture more flows in this category? What are our major strategies towards that?
Petri?
Yeah, hi Mohit, Petri here.
Yeah.
So that remains actually our focus in terms of the hybrid strategies, and that's just a function of where we think the market is, both in terms of valuations as well as valuations of both equity and fixed income, which is why we think this is a sort of more appropriate part. There has been perhaps some churning of portfolios, but we are just doubling down on the push in terms of hybrid products. Our products, particularly the multi-asset fund and the aggressive hybrid fund, are already approved on several platforms. So we are pushing there both for sales through lump sum mode as well as through the SIP mode. The Balanced Advantage Fund is a much younger fund for us, just about 2 years of track record, but it's done well over that period. So even there we are, sort of increasingly pushing the market in terms of starting to get that incorporated. As you know, many, sort of rating systems in the market typically look at least 3-year data before they start to, recommend a product. So once we cross that hurdle sometime middle of this year, hopefully that product as well will make it onto some of the sales platforms. So there may be some movement that you've seen over the last quarter, but I think we are happy with the trend that we see in terms of gross sales.
Okay, and H2 should be better than H1, I presume.
Yeah, that is where our focus remains, and we've been doing a lot of distributor engagement over the last few months. There's a series of programs we are doing across the country, zone by zone. So I think you will see some benefits of that.
Understood. My second question is towards the UTI international business. So I think there has been around 8% decline, if I compare H1 26 versus 25. So any activity over there?
So the AUM decline that has happened over there is primarily because of two funds. One is UTI Finex Fund, which is similar to a FMP kind of a category, which has matured, and some redemption and mark-to-market impact on our UTI India Dynamic Equity Fund and UTI Innovation Fund, where we lost close to around 2,000 crore, primarily because of mark-to-market impact only. So hopefully with the growth category style actually delivering better values over last 2 or 3 quarters, we should see some meaningful inflows in UTI Dynamic Equity Fund going forward.
Understood. My last question
just to add some color to what Vinay said, just keep in mind that you have to also see the change in AUM of that strategy in the background of the fact that in general FPI appetite towards India is currently fairly cooled in that sense, right? There's been a net outflow. So India as a category is actually not attracting too much flows at this point of time. But within that, I think the team has been reasonably successful in terms of getting some inward client rotation. And that is coming from what Vinay said, which is that when we look particularly at the last year and a half, the quality growth which underpins the IDEF strategy that we run has done quite well in terms of its alpha generation. So that has enabled the sales team to get more clients in. But we need a point in time where overall appetite for India starts to increase for that number to grow.
Understood. No, that's helpful. My last question is towards, in your opening remarks, you said that the impact of VRS is expected to be around 25 odd crores. So just wanted to know the math behind that as to how did you come, with that number, if you could just explain.
No. What we stated that as part of a VRS package, the family pension amount was being revised. That because of the revision in the family pension amount, the actuarial impact of that has been accounted for in Q2. The actual impact of VRS will depend on how many number of people actually opt for, and that we will be communicating sometime in maybe in the later part of the month of November. So information will be sent out to the stock exchange of what the actual impact will be there in Q3 financials.
Mohit, it is a one-time expenditure, and as per the accounting policy, based on the actuarial valuations, we need to account for in the quarter of the incident. And therefore, since the scheme was launched on 23rd of September, therefore, as per the accounting standard requirement, we had to account for in this quarter. It is a one-time expenditure. And let me give you the why this particular thing is a part of the package. We have a pension scheme, and this pension scheme, the family pension scheme was not revised since 1994, and the only thing people were getting the 5,300 rupees family pensions across the group of the employees, whether it is the class 3, class 4, or even the senior management people. Therefore, we have revised the family pension schemes. And that we did in order to make sure that our VRS scheme is successful. And we are seeing the good outcome. Mohit.
Understood, sir. So thanks. That's very, very helpful. Thanks, and wish you all the best.
Thank you.
Thank you. Our next question comes from the line of Prayesh Jain from Motilal Oswal. Please go ahead.
Yeah, hi. So just extending that question on the VRS thing. So while you've not quantified the cost, but you would have an estimate if all the 100% of the employees eligible for it, if they accept the VRS, what would be the cost that can be seen? And I would also like to understand what happens if the 100% of the employees take VRS. Post that, what kind of employee cost run rate will we see?
Vinay?
So overall, the number of employees that are eligible for VRS is 479 out of roughly around 1,450 employees that we have. So only 1/3 of the employees are actually eligible for VRS. And these are primarily the employees who are more than 50 years of age and joined prior to 2003. The actual impact will again depend on the number of people that actually opt for a VRS. But I can give you a ballpark number. The average VRS payout would be in the range of, per employee, would be in the range of around 60 to 65 lakh. So depending on the number of employees that actually opt for, then I can communicate the actual impact. And what was the second question, Prayesh? I didn't get that.
If 100% employees opt for the VRS, how much?
One employee, one year.
No. So no, we don't have. We have analyzed it, and we are not required to replenish all employees. Our data suggests that in case all 500 employees take the VRS, over a period of time, we will be requiring 70 to 75